Welcome to The Explainer. Today, we're taking on one of the absolute most stressful parts of modern life, managing our money in a world that literally never stops screaming at us. Our goal here is pretty straightforward. We want to help you shift from being an anxious, constantly reacting market participant to a calm, collected, long-term investor. We're going to build something we call the bouncer mindset. By the end of our time together today, you're going to have a rock-solid framework to protect your portfolio and, honestly, your peace of mind from that relentless fire hose of financial noise. So, let's kick things off with a super fundamental, incredibly human question. Why does doing absolutely nothing feel so wrong? I mean, think about it. You probably get, 50 to 100 notifications on your phone a day? The market is dipping, inflation is doing something crazy, a new geopolitical crisis just hit the headlines. It feels like the world is falling apart 3 or 4 times a year. And in the middle of all that chaos, just sitting on your hands and not touching your portfolio, it goes against every instinct we have. It feels like you're just totally failing at being a responsible adult. Well, it's actually an ancient Roman army rule that hits the nail on the head as to why we feel this way. It goes, action removes fear. When things get scary, doing something, literally anything at all, makes us feel like our hands are firmly back on the steering wheel. Even if it's completely an illusion of control, making a quick trade or tweaking our investments gives us this instant psychological comfort. But here's the catch. In the world of long-term investing, this perfectly natural, totally human instinct, it's actually your absolute worst enemy. Think about the crazy contrast here. In almost every other aspect of life, hustle pays off. If you study harder, your grades go up. You hit the gym more, you get stronger. Effort equals results. But in the financial markets, doing more stuff, constantly trading, trying to outsmart everyone, it usually guarantees you way worse results. The great irony of investing is that doing nothing is actually incredibly hard work. Why? Because you have to do all the heavy lifting up front. You have to set your guidelines, automate your decisions, and lock in your plan well in advance. That way, when the inevitable panic hits, your only job is to stand perfectly still. Now, to actually be able to stand still when the storm hits, you have to do a little soul searching and define your true risk profile. Before the market gets choppy, you really need to know who you are. Are you naturally a conservative investor, like you prioritize sleeping soundly at night, even if it means you might see slightly lower returns over time? Or are you an aggressive investor, someone who wants their foot slammed on the gas pedal, totally willing to ride out some stomach-churning volatility for those bigger long-term gains? Look, there's no right or wrong answer here, but you absolutely must know your identity. Because if you build a super aggressive portfolio, but you actually have a conservative heart, you are guaranteed to panic and bail out at the absolute worst possible moment. Okay, let's look at how this plays out in the real world with a guy named Bob. You've got to hear about Bob because he is, without a doubt, the world's absolute worst market timer. Listen to this track record. Bob saved up all his cash and only decided to invest it at the absolute very peaks of the market right before the 4 most devastating crashes in modern history. I'm not kidding. He bought right before the market got cut in half in 1973. He threw more money in right before the brutal 1987 crash, where stocks plummeted 20% in a single day. He bought again right before the dot-com bubble burst in 2000. And his final grand investment? Right at the peak before the 2008 Great Financial Crisis. Statistically speaking, his timing is an absolute disaster. But here is the absolute wildest part of the story. Even with the worst market timing in human history, Bob ended up with over $1 million. I know, how is that mathematically possible? The secret is this. Bob never panicked, and he never sold. Sure, he bought at the worst possible times, but he stayed fully invested through the absolute darkest, scariest days of those crashes. He just stepped back and allowed the profound mathematical power of long-term compounding to do its thing over the decades. It turns out a remarkably long time horizon will mathematically smooth out almost any terrible timing mistake you make, provided you don't panic and hit that sell button. But let's be real for a second. We are human beings, right? Watching your life savings drop by 50% is terrifying. Bob is a theoretical legend, but most of us would have cracked under that pressure. So how do we actually survive that kind of volatility in the real world? The answer is diversification. You have to deliberately balance your portfolio to withstand entirely different, totally unpredictable economic cycles. Diversification isn't about protecting your money week to week. It's about surviving long-term cycles. Asset classes are always changing shape. Sometimes they all surge together, and sometimes they row in completely opposite directions. You need a mix that can weather literally any economic environment. Which brings us to a really fascinating, legendary example. Jack Bogle, the absolute pioneer of the index fund, used a brilliantly simple portfolio allocation: 50% stocks, 50% bonds. Now, if you're a major finance nerd, you might hear that 50-50 split and think, wow, that's terribly unoptimized. That is definitely not going to maximize returns on a spreadsheet. And mathematically, yeah, you'd be totally right. But Jack Bogle didn't design his portfolio to win a math competition. He designed it as an emotional safety valve for his own human psychology. Just listen to this incredibly honest quote from Bogle himself. He said, "Half the time I worry I have too much in stocks, half the time I worry I don't have enough." That quote right there, that beautifully captures the entire philosophy of risk management. Because ultimately, investing is just a massive exercise in regret minimization. A good enough portfolio that you can actually stick with when the market is crashing is vastly superior to a mathematically perfect portfolio that you end up abandoning in sheer terror when times get tough. Your portfolio literally has to account for your human flaws. Let's use a super cool historical analogy to really lock this concept in. The Wright brothers. When they traveled down to Kitty Hawk to try and get that very first airplane off the ground, they didn't just bring the plane. No, they packed a massive crate of spare parts. Why? Because they were smart enough to fully expect that things were going to break. They knew the unexpected was a guarantee. Think of your portfolio the same way. Diversified assets, whether that's bonds, cash, value stocks, international equities, those are your spare parts. They act as a vital, stabilizing safety net that perfectly complements your main growth strategy for when your primary engine inevitably sputters out. But look, even if you have this beautifully balanced portfolio, you're still up against a massive modern challenge: filtering the sheer volume of media noise. Surviving the 24/7 financial information fire hose is no joke today. Decades ago, financial advisors would just tell their clients, hey, ignore the noise. But in the smartphone era, with relentless push alerts, breaking news drops, and this huge explosion of AI-generated content, ignoring it completely is practically impossible. You can't just close your eyes and pretend it's not there. You need a highly deliberate, highly systematic filtering system if you want to survive intact. And that brings us to your ultimate superpower as an investor. It's something the wealth manager Josh Brown likes to call the bouncer rule. I want you to literally picture yourself as a bouncer. You're wearing a sharp suit, standing behind a velvet rope outside a wildly exclusive VIP club. Well, your portfolio is that club. First rule, less is more. Second rule, you define the strict entry requirements before the club even opens. Third rule, you say no to absolutely everything else. When a hot new stock tip, a terrifying doom-scrolling alert, or some crazy complex new asset class walks up to your velvet rope, your default job is to cross your massive arms and just say, no, you're not getting in. You have to ruthlessly restrict what gets to influence your long-term strategy. So as we wrap up this explainer, I want to leave you with one final provocative question. What are you leaving out of your club today? Seriously, which specific push notifications are you going to finally toggle off? Which financial doom-scrolling habits are you committing to abandon right now? The secret to long-term wealth isn't about reacting perfectly to every breaking headline. It's about defining your rules up front, embracing the total discomfort of doing absolutely nothing, and standing incredibly firm at that velvet rope. Take control of your club, filter out the noise, and just let time do the heavy lifting. Thanks so much for joining me today, and happy investing.